Magandang hapon po. I'm so glad to be a member of the MAP, and Donald has assured me that I'm up to date on my membership dues. I wanted to talk a little bit about the outlook, partly because that's what I'm expected to talk about, but I also want to talk also about what we're trying to do to make monetary policy more effective. So that part might be a bit too nerdy, but I think it's useful for the MAP membership to know about it. In terms of the outlook, we have good news and we have bad news. The good news is inflation. At the BSP, our mandate is price stability, and that mandate we have achieved. Inflation has been coming down. It peaked at 8.7% in January 2023. It came down to around 1%, and we project that it will hover around 3% over the next 2 years. 3% is our target. And then we have a tolerance band around 3%, which is 1% on each side. Although for me, I don't mind too much if inflation falls below 3%. Falls to 2%, falls to 1.5%. Okay lang sa akin yun. I worry more when it goes up beyond 3%. So we've achieved that so far, and even more important to us is that for the bottom 30% of households, inflation is even lower than it is for the average. So that's the good news. The bad news, of course, is our growth has stalled. Although it hasn't stalled as much as you would think, because the way we've computed our growth rates, we count expenditures. There's an expenditure approach in what's called national income accounting. And when we count expenditures, it looks like we had very high growth rates in 2023 and 2024. But when we realize that not all that money actually went into investment or consumption, a lot of it went into cash that was stored in people's basements, then we have to adjust the numbers. And when we make that adjustment, it looks like we exaggerated our growth rate in the past 2 years. And so if we compute our growth rate in 2025, it was bad, but not as bad as it looked. So we're saying now that actually we didn't decline to 4.4%. We declined to 4.7%. So it's a little better than what we thought, but it's still a decline. So that's the bad news. Our growth has stalled. And as you know, it stalled mainly because of a loss of confidence, especially in the second half of 2025. So consumption of big-ticket items fell, consumption of investment fell, and then most tellingly, the public infrastructure spending in the second half of 2025 fell. So we're down to 4.7%. Compared to most other countries, 4.7% is pretty good. But compared to our potential, 4.7% is pretty bad. The big risk going forward, of course, is whether we can bring confidence back. There are signs that confidence is coming back. Tentatively, slowly. When we look at some indicators, and one of the best indicators of that is when we do a survey supply chain managers. The blue line and the yellow line are two different surveys of the same thing, but the blue line at least has gone up. When that number exceeds 50%, then we're okay. So the blue line, which is the bigger survey, has gone above 50%. The yellow line is still below 50%. If you look at the yields on the bonds that we issue, the GS bonds that are issued by the Bureau of the Treasury, the yields have been coming down. That's a sign of confidence. That's a sign of confidence. As of February 2026, the 10-year yield was 5.95%. That's pretty good. That's pretty good. So that's at least the investors in those bonds have some confidence. The stock market, as you know, the index fell, but the index has since recovered, as you can see in the graphs. The broken line, by the way, is July, so that's when the confidence crisis started. So it looks like it's beginning to come back, not as fast as we would like, but it's coming back. And in our projections, we think that we will be back to normal by the second half of 2026. So that's the outlook. Another piece of good news is when you look on the side of financial stability, we're in very good shape. The banks have very high capital buffers. In other words, if there's a big loss, they can cover it. And they also have high liquidity buffers, which means that if there's a run on that bank, there's a run on deposits, there's enough liquidity in our banks to cover that. And then finally, when we look at our balance of payments, and we've been through several balance of payments crises, but this time we have ample exchange reserves, $112.5 billion in exchange reserves. The standard for saying ample reserves is whether you have enough for 3 months of imports. We have enough for 8 months of imports. Then another standard is whether you have enough to pay to cover your short-term debt. We have 3 times that amount. So in terms of exchange reserves, we're okay. So that's the outlook. There's good news and there's bad news, but I'm optimistic that the bad news will go away, and then we'll be back on track by 2020. This year, we'll be back on track this year. We have a project at the BSP which is to make the monetary transmission mechanism more effective. As you know, when we do monetary policy, we have, I would say, 1.5 tools. One tool is the policy rate, but the other tool is what we say about what will happen to the policy rate. I would count that as half a tool. So maybe we have 1.5 tools for monetary policy, for making sure that we have price stability. The policy rate, as you can see in the graph, it goes through the money market, and the forward guidance goes through the bond market in terms of yields. In the money market, we were very surprised when we did a careful survey of which parts of the market are most active. We found out that the most active part of our money market is not the interbank call market, which we had assumed all along was the most active part. Hindi pala. The most active part of the money market today is the FX swap market. In other words, if you need peso liquidity, you need dollars as collateral in an FX swap market. That's kind of weird. That's kind of strange. in other jurisdictions, in other economies, the most active part of the money market is usually the repo market. We had a repo market, I don't know, 20 years ago, and it died. We don't know why it died. But globally, the standard contract for a repo is called the GMRA contract. The global, the global, I forget what the M was, GMRA. Anyway, the GMRA contract is standard in the rest of the world. It's accepted in 70 jurisdictions, but not in the Philippines. So we introduced it last year. We kind of cajoled the banks to sign the contract so that they could do repos among themselves. And that has worked. And now the repo market is approaching the size of the FX swap market. And we think it will overcome, it will become the main part of the money market, which means a more efficient money market. Global Master Repurchase Agreement, that's what GMRA stands for. So we have that in place. It's working. It's very promising. And then the forward guidance, when we tell you what we might do going forward with the policy rate, we might raise it, we might pause, we might lower it. That's our forward guidance, and that's supposed to affect the yield curve. When we look at the existing yield curve, which is called BVAL, or Bloomberg valuation, it doesn't make sense. When we say when our forward guidance says we might lower the policy rate, the BVAL curve doesn't seem to reflect that. And then the BVAL curve has kinks. In other words, people don't do the usual arbitrage between neighboring maturities that tend to smoothen the yield curve. That happens in many other countries. It doesn't happen here. So we decided to do something through the back door. We decided to emulate what the EU has done. In 2000, as you may remember, the EU decided to switch to a single currency. I think at that time there were 15 jurisdictions that were part of the EU, and so 15 currency, the lira, the Italian lira, the French franc, the German mark. They decided just one currency, which would be the euro or the euro, which left the bond markets fragmented in Europe. So what they did in the EU is they introduced the IRS contract, the interest rate swap contract, which means to take a position, you don't have to buy or sell the whole bond. You just buy this contract, and you're responsible for only the differential between the long rate and the short rate. So the banks have been here. We introduced this contract last year, and the banks have been signing up, and the IRS curve is now, I would say, there are prices up to 5 years, but there's activity mostly at the 6-month maturity and increasingly at the 3-year maturity. So it's beginning to take shape, and it's beginning to look like an effective yield curve in terms of the transmission of the monetary policy. So I think we're making progress, but slow progress. So as I said, we're going to shift from the FX swap to the repo, and then we're going to shift from BVAL to the IRS curve. So to summarize, I think when it comes to inflation, we're doing okay. Growth has stalled, but recovery seems to be on its way. And then the risk remains confidence, whether confidence will come back or not. I think it will. The government is beginning to make some progress in governance reforms. And so if that continues, we should have confidence back this year, sometime this year. So maraming salamat. That's all I have to say.